Dirty dealings, corporate battles, consumer woes. This is Evening 5. Property developer P Setia says it has initiated legal action against its former senior management and a former director over alleged breaches of duties linked to the purchase of lands in Kota Kinabalu, Sabah under the group's aeroport project. Former Deputy President and COO Datuk Wong Tak Wai, currently CEO of IGM Land, former Executive Vice President Datuk Kau Chung Ming and its former President and CEO as well as Director Datuk Kor Chap Jen were among the 11 defendants P Setia named in the suit. The other defendants were Wilfred Yong Cheng Leong, Alan Wong Siu Ong, Prestigo Properties, Asia Dream, MM2H, Optimised Profit, Glory Wise Century, Big Deal Synergy and Sinarmaju, its bourse filing on Tuesday showed. The suit further alleged breaches of duties by Wong Kau and Kor as well as dishonest assistance, conspiracy, deceit and the breaches of agreement by the other defendants. The writ and statement of claim was filed by P Setia and its subsidiaries, namely Aeroport and Setia Bina Raya, at the High Court of Shah Alam. In the suit, P Setia is seeking the court to declare that Aeroport is entitled to the ring-fence money of 60.67 million as security towards the performance of Prestigo Properties obligations. Further, P Setia is seeking damages or equitable compensation for the additional sum of 37.59 million after the deduction of the above-mentioned ring-fence money. On top of that, the property developer is also claiming for damages or equitable compensation for late payment interest of 5.2 million up to December 31st, 2020 and for the interest from January 1st, 2021 until the final settlement to be assessed by the court. The suit is fixed for case management on September 18th, 2024. P Setia first introduced the plans for the aeroport project, a mixed development anchored by the railway hub of Kota Kinabalu in Tanjung Aru back in 2013. Public Bank, Malaysia's third largest bank by assets, saw its second quarter net profit improve by 10% year-on-year to 1.78 billion thanks to higher net interest income and non-interest income. Net interest income rose 5% year-on-year to 2.32 billion ringgit. Non-interest income was 674.75 million ringgit. The bank also declared a first interim dividend of 10 cents per share. For the first half, Public Bank saw its net profit tick up more than 3% to 3.44 billion, while revenue increased 8.9% to 13.5 billion ringgit from the 12.4 billion posted a year ago. In a separate statement, the group said the better performance was driven mainly by growth in the loan and deposit businesses and further supported by growth in non-interest income. Public Bank elaborated that coupled with prudent cost management and sound asset quality, the group achieved a net return of equity of 12.8% for the first half of FY 2024. Operating expenses continue to be prudently managed according to the company, reflected by the group's cost-to-income ratio of 35.3%. Public Bank's total loan portfolio sustained its upward momentum in the first half, rose by an annualized rate of 6% to 411 billion ringgit. In particular, the domestic loan portfolio expanded by 5.9% on an annualized basis to 383.7 billion, outperforming the Malaysian banking industry's annualized loan growth of 5%. The bank's loan loss coverage ratio stood at 154.2%, which was above the banking industry's loan loss coverage ratio of 91.7%. Public Bank also continued to uphold its capital position with its Common Equity Tier 1 capital ratio at 14.5% and total capital ratio at 17.4%. Sime Darby ended FY 2024 on a strong note with net profit more than doubling to 3.31 billion, largely due to a 2 billion ringgit gain from the disposal of Ramsay Sime Darby Healthcare in December 2023. Stripping out the one-off item, the automotive and industrial conglomerate reported a core net profit of 1.3 billion in FY 2024, up 14% year-on-year on higher profits from the industrial business in Australia, the strong performance of the motor Motors businesses in Malaysia, Singapore and Taiwan, as well as maiden profit contribution from the UMW division. Revenue for FY 2024 jumped 39% to 67.13 billion from 48.29 billion previously. Sime Darby declared a second interim dividend of 10 cents per share, which brings the total dividend payout for FY 2024 to 13 cents per share or 866 million. However, for the fourth quarter, earnings fell 85.7% to 89 million, mainly due to one-off impairments and provisions at its Motors division, losses at its Motors operations in China, higher finance costs and deferred tax provisions, according to the group. Nevertheless, revenue for the quarter saw a 41.4% improvement to 18.8 billion ringgit. Group CEO Datuk Jeffrey Salim Davidson said that after successfully completing the acquisitions of CAF Power and UMW and concluding the sale of Ramsay Sime Darby, the group can now fully focus on growing its core businesses of motors and industrial. Going forward, Sime Darby points to excess production by automotive manufacturers that have led to an oversupply situation affecting China and other markets in which the group operates. This has led to downward pressure on margins, a situation Sime Darby expects to persist through FY 2025. However, the strong performance of the industrial division, it says, continues to be supported by robust demand for equipment and maintenance support from the mining industry in Australia. Despite the challenging market situation, Sime Darby expects its core financial performance for FY 2025 to be consistent with that of FY 2024. RHB Bank says it is confident of achieving return on equity of more than 10% for FY 2024 from its current ROE of 9.4%, given the improving operating landscape and economic conditions in the key markets that the bank is serving. Group MD cum CEO Muhammad Rashid Mohamad said the bank is also confident it would be able to exceed its internal loan growth target of 6.5% to 7% for the coming quarters in 2024. The bank is also expecting its net interest margin to be stronger than the current 1.89% for the second half, helped by less intense competition among banks for funds and the bank's effective use of foreign currency swaps. Overall, domestic retail makes up 51% of RHB's total loan, while domestic wholesale banking contributes 21% and small and medium enterprise 12%. The bank's Singapore operation contributes about 13% of its total loan. To capture opportunities that arise from foreign direct investments into Malaysia, Rashid said the bank's strategic focus on Johor would supplement its Singapore operations to do so. Meanwhile, RHB saw its net profit for its second quarter drop by 11% to 722.3 million as provisions dragged its bottom line. Net interest income rose 11% year-on-year to 989.4 million, while non-interest income nearly doubled to 603.2 million ringgit. RHB also declared a dividend of 15 cents per share. For the first half, net profit was down 7.5% year-on-year to 1.45 billion, while net interest income for the period was up 7.9% at 1.92 billion, while non-interest income surged 41% to 1.11 billion ringgit. Muhammad Rashid said that the bank is set to embark on its new corporate strategy due to be launched in the first quarter of FY 2025, adding that RHB remains steadfast in its strategic priorities and are well positioned to navigate the evolving market landscape. FGV Holdings returned to the black for its second quarter, posting a net profit of 86.4 million compared with a net loss of 12.9 million a year earlier. The better earnings were due to higher profits in the plantation and logistics and support divisions, but this was partially offset by weaker performance in the sugar and oils and fats division. Revenue for the quarter improved by 23% year-on-year to 5.52 billion, driven by a higher average crude palm oil price and sales volume. No dividend was declared for the quarter under review. It was a similar story for the first half, where FGV also managed to post a net profit of 72.9 million versus a net loss of 805,000 in the previous year. Revenue for the 6 months rose 10.7% year-on-year to 10.06 billion from 9.09 billion a year earlier. On prospects, FGV said demand and supply for palm oil is expected to stay steady in the second half. It is projecting the CPO price price to be between 3,800 ringgit per tonne and 4,000 ringgit per tonne in 2024. Operationally, the planter said it will continue prioritizing yield enhancement initiatives within its plantation operations by closely monitoring crop harvesting processes and expanding its mechanization. On the cost side, FGV said the drop in fertilizer prices has helped reduce production cost pressures and is anticipated to continue softening throughout 2024. As for its sugar division, the group says it remains cautious about the rising geopolitical tensions, which may increase input costs and impact financial performance. Simultaneously, the division is strengthening its presence both domestically and for export markets. Barring any unforeseen circumstances, FGV is expecting a satisfactory performance for FY 2024.